Hello everyone. Today we will be discussing the auditing standard SA570 ongoing concern. This revised auditing standard is effective for audit of financial statements for periods beginning on or after 1st of April 2017. Let's just first understand the scope of the standard. It deals with the auditor's responsibility in the audit of financial statements relating to going concern. As we will discuss in the subsequent slide, we will look at the appropriateness of the going concern assumption in the preparation of financial statements and whether there is any material uncertainty which requires any disclosures and the implications, if any, for the auditor's report. Before I get into the details of the standard, I think it is good to kind of have a very broad understanding of the changes that this revised standard is seeking to bring in compared to the earlier SA 570. There is a very interesting concept which is generally referred to as a close call situation, which has now been introduced. It seeks to capture very early stages of sickness. So while there may be not any material uncertainty of going concern, however, there may be certain matters which are very relevant to the understanding of the financial statements in this regard and which may require disclosure. The standard also brings in very specific requirements regarding the responsibilities of the management as well as the auditor with regard to going concern. We've been saying going concern, but what does going concern really mean? When you look at a going concern basis of accounting, it means that the financial statements are prepared on the assumption that the entity is a going concern and will continue its operations in the foreseeable future. When it is appropriate to follow going concern assumption, it means that the entity will be able to realize its assets and it will also be able to discharge its obligations in the normal course of business. The general purpose financial statements are prepared using the going concern basis of assumption unless the management intends to liquidate the entity or there is no other alternative for it but to cease operations. Let's just understand the auditor's responsibility. Maybe before the auditor's responsibility, maybe the management's responsibility as far as the preparation of financial statements and use of the going concern assumption is concerned. Management has a responsibility to make an assessment of the entity's ability to continue as a going concern. When the management is aware in making its assessment of material uncertainties related to events or conditions that arising from events or conditions that may cast significant doubt on the entity's ability to continue as a going concern, disclosure of these uncertainties is also required. As you will appreciate, this will require a wide range of factors relating to current and expected profitability, timing of cash flows, various other factors which may need to be considered before the management also makes an assessment that the use of going concern assumption is appropriate. It will also require management to make certain judgments, and those judgments will be made at a point of time. And obviously, these will involve certain inherently uncertain future outcomes of events or conditions. So as you will appreciate, the judgments will be impacted by how further into the future these events or conditions or outcomes occur, the size and complexity of the entity. Also, any judgment is based on the information available at the point the judgment is being made. Subsequent events may result in outcomes which are different than those which were considered to be reasonable at the time the judgment was made. Typically, the standard would expect the management management assessment to cover at least 12 months from the reporting date. However, certain cases may even require a longer period to be considered. Let's move now to auditor's responsibility as far as assessment of going concern is concerned. I would like try to take this example kind of just to put the requirements in the context. So just think about it. Let's say you're looking at a client, audit client, which has a fact pattern similar to what is there on the slide. So in this, you've got a company which is a wholly owned subsidiary of its, company P. When you look at company S, which is the company being audited, you realize it has negative operating cash flows. There is erosion of net worth. However, there has been so far no default in settlement of operating liabilities or borrowings, etc. If you look at the parent, which is company P, the parent has reasonable financial credentials. It has even provided a letter of support to enable the subsidiary, which is company S, to continue as a going concern for the next 12 months. And company S also provides relevant disclosures relating to the going concern matter in the financial statement. So what would be the responsibilities of the auditor in a situation like this? Just keep this as the context, and then we will be going through the requirements of the standard, keeping this as a reference example. So the auditor's responsibility would be to obtain sufficient appropriate audit evidence and to conclude whether the management's use of going concern basis of accounting is appropriate. And let's say the auditor concludes that the use of going concern assumption is appropriate, but are there any material uncertainties which need to be considered and disclosed or taken into account? Logically, this would require the auditor to determine whether the management has already made a preliminary assessment of the company's ability to continue as a going concern. The auditor, if management has done so, the auditor would evaluate the management's assessment, and if there are certain conditions or events or outcomes which are identified which may cast doubt on the entity's ability to continue as a going concern, the auditor will be required to undertake certain additional procedures, which is quite logical. So let's look at step 1, wherein we would see whether in a situation similar to on the slide, whether the management has made any assessment. If the management has made assessment, we will move on to the next stage, which is to evaluate that assessment. But if management hasn't made any assessment, the auditor would be required to understand from them as to how have they reached the conclusion on going concern and on what is the basis on which they have prepared financial statements using going concern assumption. As we will also see through our discussion, the auditor has to remain alert at all points of time of audit for any events or conditions which may cast significant doubt on the entity's ability to continue as a going concern. So let's say in the situation that we have, you speak to the management and you determine management has done its assessment and they've concluded that it is a going concern. The next step would be for the auditor to evaluate this management assessment. The first bit in terms of evaluation of management assessment would be the period for which I need to take into account the information. So if the management assessment, like we discussed earlier, should typically consider 12 months, if the management assessment is for less than 12 months, the management should be asked to extend their assessment. It may also happen that you may need, there are certain developments because of or certain information comes into your notice as part of your audit process, because of which you believe the assessment needs to be extended beyond 12 months. So while 12 months is the minimum period, it is not the maximum period. So this is typically what we would do in terms of evaluating management assessment. We will try and understand whether determination made. If yes, what is the basis? Does it cover minimum 12 months? If not, ask the management to extend. If you believe given the certain specified circumstances, further period needs to be considered, do that. Now, what are some of the additional procedures that an auditor would carry out when they come across these events which cast a doubt on the entity's ability to continue as a going concern? When you look at the management's assessment in such a case, the auditor would need to objectively challenge management's plan and significant assumptions. They may need to consider, like I said earlier, events and conditions even beyond the management's assessment by making inquiries of management. So typically you would look at what are the events which are giving rise to this uncertainty? or let me not say uncertainty, what are the events which are raising a significant doubt on the entity's ability to continue as a going concern? How does the management intend to deal with those, and the reliability of those management plans? So this is typically an approach which the auditor would follow. While doing the evaluation, it would also need to be seen whether there are any complex cash flows assessment which needs to be considered. Does the auditor need any expert to be involved? What are the basis of the assumptions that the management has used? Management's plan of future action. So, for example, management in the situation, if I go back to the slide, management may share certain plans to improve their operating cash flows, or to say how the net worth will be, the erosion of net worth will be capped and so on. What are those plans? How reliable or realistic are those? That is another bit. So therefore, effectively, the auditor will have to see whether assumptions are realistic, whether they are achievable in view of the entity's circumstances, how consistent are these assumptions with the general economic environment and understanding of the entity. So let's now take the fact pattern that we have, and let's just see what are the possible outcomes once we've evaluated the management assessment of going concern. What are the possible conclusions that the auditor can reach? Let me just do that by taking a spectrum. Just imagine on one end of the spectrum, you've got a situation where the situation is a very clear situation, which means there is no event or condition which raises any significant doubt. You've got a very clean case of going concern assumption being appropriate. At the other end of the spectrum, you've got a situation wherein clearly the going concern is not appropriate. So these can be the two extremes, and in between, actually, the standard recognizes that you can have two more situations. Okay, so let's say if I was to move from situation one to the end of the spectrum, I have a situation which is absolutely clean, going concern assumption appropriate. As and when sickness starts coming in, no company becomes sick immediately. There are stages through which it goes through and eventually becomes sick. So let's say from a clean, it will reach a situation wherein certain events have happened which raise significant doubt. However, as an auditor, you conclude, and the management, of course, has also concluded that it doesn't impact your going concern assumption, which means there is no material uncertainty as far as going concern assumption is correct. Let's say this sickness becomes deeper, right? Then you reach a stage wherein you actually conclude that these events or conditions are giving rise to material uncertainty in going concern. And the last stage, like I said earlier, will be the end stage wherein you actually conclude that going concern assumption is inappropriate. So on a sliding scale, as you were to see, clean situation, then you've got a situation wherein there are some events which raise doubt, but no material uncertainty. This is what we refer to as close call situation. The third stage is material uncertainty, and the last is going concern being inappropriate. So let's look at our responsibility for all these four stages. Let me start with situation one, wherein the going concern assumption, use of going concern assumption is appropriate, and it is clear that no material uncertainty exists. The standard now requires the management responsibility as well as the auditor responsibility relating to going concern to be very specifically included in the audit report. So now the audit report will have in the management responsibility a paragraph which will talk about the management's responsibility for going concern. Similarly, you will have now a specific para regarding auditor's responsibility on the appropriateness of management's use of going concern. There would be no other reference to going concern in a